Recently, I've been hearing a lot about this Apple's market cap going to $1 trillion, being the first company to ever do that, and a little bit later, Amazon being the second company to do that. And it got me thinking back to the internet bubble around 2000 when there was a company that was supposed to be the first to hit that $1 trillion market cap. And this is 18 years ago. Now, I was wondering, how is it possible that that company didn't hit that $1 trillion market cap that long ago when everybody knew it was going to happen? I mean, there were a lot of stories about it all the time. That's what got me remembering about it. So I figured I'd go take a look and see if I could find some of these articles. Um, wasn't too easy to find the article about this, even though I know there were many. I remember reading them and seeing them on TV and whatever, but apparently a lot of news organizations don't really want to keep those kind of articles around. Maybe it's a little embarrassing or something, but I did find one, and this is the Silicon Valley Business Journal. And the headline is Firm's Market Cap Climbing to 1 Trillion. Okay. Now, today you have these stocks that can do no wrong, like the FANG stocks. It's a group of stocks, Facebook, Apple, Amazon, Netflix, and Google. And they just, they keep going up and up, and everybody loves them and all that. Back in the internet bubble, we had the same thing, except it was called the Four Horsemen. And it was Intel, Microsoft, Sun Microsystems, and Cisco Systems. And Cisco Systems was the leader of them all and had the biggest market cap. And Cisco Systems is the one that everybody said was going to be $1 trillion very soon. It wasn't a question of if, it was a question of when. So it could be in 6 months, in a year or 2 years from that time around 2000. Problem is, this is right about the time when the internet bubble was bursting. So let's take a look at what happened to Cisco before the internet bubble burst and after, and where it is now in terms of its market cap value and how it compares to Apple and Amazon. And also, I'm going to talk about uh, basically how not to buy into the hype of hyped up investments, whether it's stocks or cryptocurrencies or whatever. So let's have a look at this article here. Uh, First line, $1 trillion. That's how much at least one analyst believes Cisco Systems will be worth in a few years, and you'd be hard pressed to find anyone to disagree. Totally true. Everybody believed it. Like I said, it was just a matter of, did you think it was going to happen in 6 months or 1 year or maybe 2 years tops? Okay. So looking at this red box here, the first one, it says 37 investment banks recommend either a buy or a strong buy. None recommend a sell or even a hold. Okay. So 37 investment banks all had a strong buy or a buy on this. Okay. None of them had a sell or a hold. This is at the peak of Cisco's price. Um, and so, why is that? Are all these 37 banks wrong? Did they do their math wrong or something like that? No. There's a few reasons why they all have a buy or a strong buy on Cisco or any of these kinds of stocks. The first reason is that they're investment banks, and so they want to be able to possibly get some business from Cisco if Cisco buys another company or wants to issue some bonds or issue more stock or something like that. So if you're Cisco and you want to do some business and you're looking to pick an investment bank, you're not going to pick the one that has your stock recommended a sell or a hold. You're going to pick the one that has your stock as a buy or a strong buy. So second thing is also these investment banks and brokerages, they're all basically cheerleaders when it comes to investing. So they want people to only see the good so that they're encouraged to buy into stocks and whatever stocks they're selling or IPOing and things like that. And third is that it's it's much safer to be the person with the buy or the strong buy when there's 37 other people doing it. There's safety in numbers, okay? If you're the one person that has a hold or a sell on this stock and everybody else has a buy or a strong buy, well, what's going to happen is, let's say you have a sell on the stock and the stock goes up 20% the next year. What's going to happen? One, you'll probably get fired. Two, your customers who maybe sold the stock because you put a sell signal on it are going to blame you for the money that they didn't make. Okay? Because people love to have somebody to blame for when they lost money or didn't make money. But when they make money, it's all they're doing. So so again, it's easier to be part of the group that whether you're wrong or not, it doesn't matter, because even if the stock falls, at least you could say, hey, I was part of this group of 37. We all thought, the stock was doing good, but, the market turned, and it's the market. It's out of our control. And so, the stock went down. What can you do? Okay. And the funny thing is, all these investment banks and brokerages that have buys or strong buys on stocks like this, after they tumble really badly, like 50, 60, 70%, then they all change their ratings to sell from strong buy. They don't go strong buy, hold, and then sell. They go from like strong buy to sell. And it's kind of like closing the barn door after all the horses have escaped. So a little lower in the article, you could see George Kelly, an analyst with Morgan Stanley. This is a big company. It's not a fly-by-night kind of company. It's legit. And he's also somebody who took Cisco public, so of course he's going to have good things to say about them because he wants to do more business with them. But anyway, he talks about where it's trading, and it's trading at 100 times Mr. Kelly's earnings estimate. What that means is his earnings estimate for next year. He's guessing next year what it's going to earn. Okay, he's not talking about the year before, because the year before would be like twice that. So it would be more like 240 is their price to earnings ratio. So anyway, you can't definitely forecast what a stock's going to do the next year. Okay, so that's just guessing really, and of course it's going to be on the optimistic end of the range for this guy. So the funny part is a little below that, he says a low PE, price to earnings ratio. If you don't know what that is, it's basically how much you're willing to pay for a dollar in earnings. So the S&P 500 typically has a historical PE of between about 15 and 20. So let's say at 20, you're basically saying that you are willing to pay $20 for $1 worth of earnings in a year. Okay, so the lower the PE, the better. So if you have a 10 PE on a stock, that means that you're getting about 10% on your money in terms of earnings. If you have a 20, you're getting about 5%. If you have 100, you're getting like 1%. Okay, so this guy says a low PE usually signals investors are uncomfortable. So I guess that means that a really high PE means that investors are very comfortable. Not. So let's scroll down a little bit, and here he talks about the reasons why Cisco is highly valued right now. He says because Microsoft has the Justice Department thing going on, so Cisco's a much cleaner situation. And second, Cisco has a tremendous track record of continuous upside surprises, and Cisco is viewed as opening several new markets, the biggest of which is optical, which is expected to be an explosive market. So uh, basically, he's selling the story, and the first story that was sold with Cisco, and I mean it's not to say that it's a story with no merit, because it did have explosive growth in earnings, but the story is basically that it's basically building the internet. Cisco, when they were coming out with their routers and stuff, that they were going to build the explosive internet, and there's no end to that kind of growth. And their analogy was that the internet is like the California gold rush, and the people that made money in the California gold rush were the people that were selling shovels and pickaxes and other hardware and Levi's and things like that. So their story was, we're the guys selling the hardware for the internet gold rush. Okay, that's their story. And now the new story above the horizon, if you look out a few years, is the optical networking, which is going to be an explosive market. So they're trying to justify the high valuation that Cisco had at this point. So below that it says Paul Weinstein, an analyst at Credit Suisse First Boston, also another very highly esteemed firm, believes a 1 trillion market capitalization is within reach in a few years. He said Cisco stock has increased 1,000 times, a perfect 100% annual return since it launched its IPO in 1990. That's true, what he said in terms of how much it increased and everything like that, but trees don't grow to the sky, and growth ends at some point. So just because it's done well in the past, there's no guarantee it's going to do well in the future. So going down a little bit, and it says, if you had picked a price point to sell at any time in the past 10 years, you would have been wrong, he said. They have such an impressive track record of growing that the financial community isn't thinking in terms of a multiple of what they're earning this year, but what they'll be earning 3 or 4 years down the line. Again, that's kind of a smokescreen to kind of apologize for why it has a high price now, saying that don't look at the high price. In a few years down the line, they're going to be earning so much more. So don't worry about it. It's going to grow into its high price. So are all these people cheerleaders? Is there anybody that has a dissenting opinion? Well, yep, one guy, Jeremy Siegel, a finance professor at the Wharton School, wrote this week in the Wall Street Journal that the high valuation assigned to large cap technology stocks, Cisco is at the top of his list, are unsustainable. And he goes on to say, history has shown that whenever companies, no matter how great, get priced above 50 to 60 times earnings, buyer beware. Let's take a look at the market cap for Cisco in 2000 and going up to now. And here on this chart, you see that March 28th, 2000, the market cap for Cisco was $540 billion. And then it fell a lot after that and never really recovered over the years. And now it stands at $221 billion. That's about a 60% loss from the top. And when you count inflation, which $1 back in 2000 is worth about $1.47 today, so that would mean that the same market cap back in 2000 would be about 800 billion today. And yet here we see that it's only 221 billion. So that's 70% less than where it was in 2000. So what that's saying is if you bought it around the top in 2000, 18 years later, you're still down 70% on your money. Okay, that's huge. So, why did that happen? Well, let's see. Did they, stop selling product or something like that? People stop buying their products. Let's take a look at the revenue. Okay, here's a chart of the revenue. In 2000, they had almost $19 billion in revenue. And now in 2018, they have $49 billion in revenue. So their revenue's up about 2.5 times. So they're making a lot more money than they did back then. What about maybe their net income is not so good? Well, let's see. Here's a chart. In 2000, their net income was 2.6 billion, and now it's like 9.6 billion. So almost 4 times more over the years than when it was in 2000. So if it's not that, maybe it's the earnings per share. Maybe they just diluted the stock, issued a lot of stock. So although they have good earnings, it's distributed over more shares, right? Let's see. Here is a chart of the earnings per share. And in 2000, it was 39 cents per share on an annual basis. Okay, now it's about $1.92. So it's gone up about 5 times from 2000. So it's not the earnings or the earnings per share. So what could it be? Well, here's a look. Here is a chart of the PE ratio for Cisco going from 1995 to 2017. And the reason I ended it at 2017 and not 2018 was because 2018 is really skewed because they paid out $12 billion in taxes to repatriate the money that they kept overseas over the years. So their PE ratio is really bad because their earnings are like non-existent this year because of this payout, but it's a temporary thing. So I left that year out just so you could see what it looks like normally. So in April of 2000, their PE ratio was 251. Okay, that means you were willing to pay, if you bought the stock, you were willing to pay $250 to get $1 in earnings back then. Okay, now these days it's more like 17 or 20 is their PE. Okay, so that is like what, 12 times less than where it was. And this, in a nutshell, is the reason why their market cap is nothing like Apple's or Amazon's, because back then, their market cap was inflated by their price to earnings ratio, meaning people were willing to pay any price just to buy this stock. Problem is, when you do that, these stocks always come down back to earth. The air comes out of these bubbles, and they go back to their long-term PE ratio, which is similar to the S&P, 15, 17, 20, 25, something like that. So just buying this stock, even though it's a good stock, it's a real company, it makes money, it makes more money every year, it makes more earnings every year. But when you buy it at such an inflated price to earnings ratio, you are basically holding the bag when the earnings ratio comes back down to its regular long-term kind of average. And so it's almost impossible for this thing to come back. I mean, you're going to be holding this for years and years and years to get your money back. And that's the problem with buying hyped up stocks or cryptocurrencies, whatever the hot thing is at the time. When the mainstream is reporting on it and you see it everywhere, it's usually already too late, and only the last suckers are the ones getting in just because they don't want to feel left out. they're mad that their neighbors are making money and bragging about it and all this stuff, and they just hear that, easy money, and they get in, and it always ends up badly. And here is a stock chart from Cisco. You see March 2000, it was 77.88, and now it's $48.51. So in 18 years, the stock price is still lower than where it was in 2000. And just to show you how far it fell from March 28th, 2000, where it was 77, to 1 year later, March 28th, 2001, it was $15.72. Okay, that's an 80% loss in 1 year. And this was not a fly-by-night stock by any means. This was the bluest of the blue chips, the leader of the Four Horsemen, the leader of the whole internet charge and all of that stuff. It wasn't a scammy type of stock or anything like that. So if this could happen to the leadership stocks, it could happen a lot worse to some of the more marginal or even questionable or scammy type of stocks that are out there. And there's a lot. The reason you don't hear about them is because they're all out of business now. Looking at the market cap of Cisco, Apple, and Amazon together, you see that back in 2000, Cisco dwarfed Amazon and Apple. Okay, Cisco, their market cap, like I said, was 540 billion, while Amazon and Apple were both about 22 billion at the time. So you see Cisco's market cap plummeted and never really recovered, while some years later, Apple and Amazon really started taking off. Looking at the revenue chart for all three of them, you'll see that Cisco was kind of slow and steady over the years to its 49 billion, while Apple and Amazon really ramped things up, say from about 2010. So their revenue has increased, a lot. Apple's 229 billion and Amazon 177 billion. That's 3 or 4 times more than Cisco is. Now looking at the annual net income, you'll see in 2000 Cisco had 2.6 billion, whereas Amazon was losing 1.4 billion and Apple only had 786 million. Come to 2018 and Apple is by far the leader, $48 billion in net income. Amazon only 3 billion. And Cisco, like I said, this chart is a little inaccurate because of, not that it's inaccurate, but this year they paid a lot out for taxes, so their net income is low, but it should be around $10 billion. So Apple is still about 5 times more net income than Cisco, and Cisco is 3 1/3 times, has more net income than Amazon, and yet Amazon is the $1 trillion company and Cisco is only 221 billion. So why is that? Well, again, the PE ratios. So here's all three of their PE ratios. Back in 2000, Cisco's was 268. Amazon didn't have a PE ratio because they had no earnings, so they had no E in the PE ratio. And Apple's PE ratio was 39. You could see over the years, Amazon's has spiked when they had some earnings. It's gone as high as like 600 or so, something like that. And now today, Apple's is 25, which is perfectly reasonable for a company that still continues to grow. It's so reasonable. Even Warren Buffett is a believer in Apple, and he doesn't buy inflated stocks or pay high PE ratios. So that tells you something. Also, the fact that he's not a buyer of Amazon also tells you something, because Amazon's PE is 327. So what is that, about 15 times higher than Apple's? So even though they're both trillion-dollar companies, one has a way higher PE and therefore has a lot more room to fall in the next downturn. And there will be a downturn, so don't kid yourself. So that's really the point I'm trying to make here, is that um, a few things. One is that a lot of people have never seen a bear market, okay? So since 2009, the market's been going up. So if you turned 18 or 20, just got out of college around there, and you're 32 years old, you've never seen a bear market, okay? So that makes people think it's not going to happen. When the reality is that when it does happen, um, people are going to lose a lot of money, and the people that buy the really speculative high PE stuff are going to lose a lot more money. Even Apple and Amazon during the dot-com crash, Apple lost what, about 80%, and Amazon lost like 93% from its high to its low. So those are the kind of losses that people don't come back from. You know what I mean? Especially if you have all your money in some stock like that. So just be aware that there's going to be another crash, and the stocks that have the highest valuations, which has the most euphoria about them, that you see the most in the news, and has the greatest pie in the sky stories, those are the ones that usually fall the most. And you see that Cisco, Amazon, Apple, they're real companies, real products, they have real growth and things that people need and want. And even these companies fell a lot. So when you're talking about some of these marginal stuff, or even borderline scammy stuff, those things are not only going to lose 90% or something like that, a lot of them are just going to disappear, go bankrupt, or get bought out for a few dollars or whatever, pennies on the dollar kind of thing. So when you see stories in the news about some cryptocurrency is going to be the next hottest thing and you should all get on board, and all your friends are telling you how they made money in cryptocurrencies, or the latest marijuana stock or something is going crazy, like recently one of these marijuana stocks that had only $20 million in revenue, shot up to a $20 billion valuation. Okay, and a lot of it was on a short squeeze and just some positive news about some deal that may be coming down the pike with some bigger company or something like that. So the point is that all of these hype stocks, they eventually come down to earth, and the majority of the people that buy these things are buying them at or close to the top, and they're selling them at or close to the bottom when they can't take the pain anymore of their losses. So that's kind of the reason why you see people like Warren Buffett don't fall for these high PE kind of stocks, or scam stocks, or story stocks, because not because he's a super genius or anything like that. It's because he's lived through these other bubbles and seen what happens to the stocks that have the high PE ratios, how far they fall. So his mentor, Benjamin Graham, that wrote The Intelligent Investor, also has examples of stocks from the 60s and 70s that were the darlings of the time and had high PEs. But when the market turned, these PEs went back down to the normal level, and so the stocks were decimated something like 80, 90%. So he's seen it all before. He's been through many cycles, and that's why he's more of the value and buying slow and steady stocks that pay dividends and have, traditional growth with a decent price to earnings ratio. It's the younger people that want to get rich quick, that don't have a lot of money to invest, and therefore are looking for really high returns really quickly. Those are the ones that get suckered in. And so, not to say that Warren Buffett is smarter or I'm smarter, because I'm sure he's, maybe gotten suckered into some of these when he was younger. And I sure have when I was trading some of these .com stocks for sure. So it's it just I guess some wisdom comes with age of getting stung a few times, and you see it for what it is, and the potential for the losses down the road when things turn sour, because they always do eventually. So just keep that in mind when you hear people hyping some kind of new investment or stock idea, whether it's the .coms or the fiber networking or pharmaceuticals or marijuana or whatever. They always come back down to earth eventually. So don't be the one holding the bag. Okay. Thanks for watching, and if you like this, give me a thumbs up. If you want to see more videos like this, let me know what subjects you'd like to know about in finance or any other subject. Thanks.